Welcome to the Avoidance of Foreclosure and Eviction section of the Dodd-Frank Prep course, brought to you by NHNLA. This is section 6.2, Workout Options, Retention, and Non-Retention. Understanding the foreclosure process. Workout options. So the first option we're going to discuss today is the repayment plan. The homeowner, in order to qualify for this, typically a repayment plan is for homeowners who've seen a short-term hardship, such as a decrease in income, a sudden unforeseen medical emergency. And in this case, the payments are made back to the mortgage company with a little bit extra to cover the shortage from whatever the hardship caused. The homeowner needs to have some excess income in order for this to work. They may also, the next one is a forbearance. A forbearance plan is when payments are temporarily reduced or suspended. And again, the key word here is temporarily. Typically, the homeowner must begin paying at least the full amount of the mortgage payment under the mortgage term at the end of the reduced or suspended period, plus an extra amount to pay down the accumulated arrears. So think about it in terms like this. They may have a forbearance where they're not making a payment at all, or they're making a reduced payment, and then they start a repayment plan once they're back on track. So oftentimes we'll see this occur, like I said, if there's a medical emergency or if they were laid off and maybe it took them 2 or 3 months to get back to work. So now that they're making more money, they can pay back their normal mortgage payment plus whatever shortage they had. Next, we have a modification. The intent of a modification is to eliminate the arrearage and reduce the monthly mortgage payments for homeowners who have A, recovered from their financial distress, but B, whose net income has been reduced to a level lower than it was before the default. There's also reduction of the interest rate. The interest rate may be reduced permanently, or it may be reduced temporarily depending on the situation. Interest rates may be reduced to below current market rate. However, this is usually only done on a temporary basis. The mortgage holder may also consider converting a variable, also known as adjustable rate loan, to a fixed rate loan. Another workout option is an extension. And if you're following along in your book, these are right on page 1. We're actually going into page 2 right now. There's a term extension. So you would extend the loan repayment period to help the homeowner make the payments, but over a longer period of time. So for instance, if they've been in the home, say, 10 years, then they've got 10 years, you can extend it to 30 years, or sometimes you can even extend it to 40. So that way the monthly payment is going down low enough so that they can make it. The homeowner should consider that accumulation of equity in the home would take longer if the payment period is extended. So just something to think about. But most times our folks are just looking to stay in their home, or the folks who are looking to stay in their home are just trying to do that however that is. Now, the next one is reamortization with capitalization of arrears. I know that's a mouthful, but don't let it freak you out. With capitalization, what happens is the missed payments are added to the principal and spread over the remaining balance of the loan. And this cancels the arrears or the past due amount. So it kind of brings it current because you're adding it all to the principal. The loan is then reamortized based on this new loan amount, and based on either the current interest rate or possibly a new interest rate. The next option is a reduction of the principal balance. A reduction of the principal balance may be available when the loan amount is more than the value of the property due to depreciation for reasons beyond the borrower's control. We don't see this that often, but it is a workout option. Short sales, pre-foreclosure sales. A short sale is a sale of the property for less than the amount due on the mortgage to avoid foreclosure. Generally with short sales, consequences to credit records are a little less dramatic, but the lender should agree to waive any deficiency. And that's where, as a counselor, you need to make sure that that is included in the paperwork. You want them to waive any deficiency, but make sure you counsel your clients that that may have some income tax implications for the homeowner. And what I mean by that is the amount of that deficiency. Let's say the house is sold for $150,000, but the mortgage was $180,000. Now the lender may agree not to come after them for the other $30,000, but that $30,000 may be considered income for the homeowner the next year when they file their taxes. Now, you're not a tax expert, or you may be, but if you're not certified to give tax advice, then you should just let them know that there may be some income tax implications and they should talk to their tax professional. Sometimes homeowners will have equity in their property and will need time to sell the property at fair market value to avoid loss of equity in the foreclosure. Mortgage holders often can be persuaded to consider postponing a foreclosure if the value is high enough to protect their interest during a sale process. Deed in lieu of foreclosure. A deed in lieu of foreclosure is basically giving the home to the lender, saying, I'm going to sign over this mortgage, this home, the collateral in this home back to the lender to satisfy my debt. Now note, a deed in lieu of foreclosure is possible when there are no junior liens, because the deed in lieu will not clear title of other liens. So if they have a second mortgage, can't do it. But if they only have a first mortgage and they've tried all the other options, usually this deed in lieu is one of the last options. So something to think about with regards to your workout options that you're recommending for your client, okay?